Welcome, everybody. Thank you very much for your patience while we try to coordinate across many different time zones and individuals and preparing lots of screen sharing across many different people. But welcome back to another Gust and Forecastr financial model teardown. I'd like to say this is part of an ongoing curriculum that we're doing right now, but it seems like we might be doing this until the end of time. Check out with us, stay in our community. If you want more of this kind of startup programming, we're doing fun stuff all the time. We're doing a lot of stuff with Forecastr. So if you don't know Forecastr, they're one of our partners. They participate in a lot of our education, education first programming. But something that we've seen when we're running dozens and dozens of these educational webinars is nothing speaks truer than just actual practical application of these principles. So rather than just give you a high level view of an imaginary company and how their financial models work and how they use it for investing and how that could be better, we want to actually take real startups, take a look at their models. The Forecastr team has generously reviewed them. We'll give them kind of a scorecard, set them up in their system so that we can play with them and see how they get better, but also share this with our audience so that everybody can benefit from the education. This stuff's tough. Early days in startups, things are changing all the time. So there's nothing better than actually getting kind of a real review of that and sharing it. And we are blessed with Waleed and John joining us. We're going to go through Waleed's model first, but first the Forecastr team. Going to kick things off with just a little bit of education on financial projections in general, and then we will jump right into it. As always, yes, we're recording these. Q&A, chat's open. We will save some time for the end because I'm sure there's going to be questions from both the founders and the audience. And without that, Logan and Stephen, take it away, or Logan.
All right, cool. I will take it away. And thank you so much, Ryan. As always, your introductions are amazing. So thank you so much. And everybody, welcome to another iteration, as Ryan said, of the Financial Model Teardown event. So this is something that I say this on every event, but it's something that I'm very proud of, because if you go on to YouTube and you type in pitch deck teardowns, you're going to see a million videos. If you go into YouTube and you type in financial model teardowns, you're going to see like no videos. And that's because we own it. We started this, and it's a very unique event that Forecastr has started putting on it. It's a really fun one. You can tell we get a kick out of doing this stuff. So Stephen and the Forecastr team, well, not so much these days, but what we look at and we build financial models day in and day out. So this is a really unique opportunity for us to kind of showcase our expertise in kind of a different way. So instead of building these financial models, we're reviewing them, we're giving actionable feedback to our audience and things like that. So it's a fun event, and we're really blessed to be able to put this on, and we're blessed to be partnered with Gust to help us put these types of events on. So just to make the most out of the time that we have together today, I'm just going to run through a really, really quick agenda, and then we're going to go right into the content. So I want to kick things off by just talking a little bit about Forecastr and what we do, who we are, all of that stuff. We're going to meet the judges, who are going to be me and Stephen here, but we'll tell you all a little bit more about who we are and what gives us the right to tear these models down. We're going to go through two models today. So we're going to be looking at two different models. We're going to be going through first wearable sensing, and then micro hydrogen. We're going to be going through their models, hearing a little bit from the founders, and then giving our review and feedback. And, just to kind of return the favor, we're also going to be showing Forecastr's financial model as well, just so y'all can see how we model, as the experts, in financial modeling. How do we do it for ourselves? And then we're going to open things up to a live Q&A. So we're going to try to keep that piece as, we'll kind of like see where the content takes us, but hopefully we'll have about 15 or so minutes of Q&A. Those can get very lengthy on our presentations that we give with Gust. So just to talk a little bit about Forecastr, the way that I like to kind of describe Forecastr and the value that we provide is, if you look at any publicly traded company, maybe any larger middle market company, if you look at the organizational structure of those companies, you're going to find one thing in common, and that is that they're all going to have this one department that's called FP&A, which stands for Financial Planning and Analysis, right? Now, the entire purpose of that department is to look at the business through the lens of finance and use financial models and financial projections to make really actionable strategic decisions. And those can be decisions like who to hire, when to raise our prices, which markets to go down, anything that you can think of. This is what this department is in charge of. Now, if you're a startup, you're a small business, you're just getting started, you don't have the budget to go out and hire a team of financial analysts, CFOs, or anything like that and build these crazy spreadsheets and maintain them and all of that. I used to do that for a living, and it is very, very difficult and very, very expensive. So that's why Stephen and I built Forecastr, is we wanted to take the benefit of FP&A that has always been seen by these larger companies and bring them down to now, even if you're a startup, you get a lot of the same benefits. And we do that by providing world-class software that can help you model out the financials of your business, and pairing that up with an expert analyst that's going to show you how to use the model and help you get all of the value out of financial model. So you can think of it as almost your own little starter FP&A kit. And we've got almost 700 clients that are very happy using Forecastr today, and we've been partners with Gust for a long, long time. So if you're interested in chatting a little bit with our team about Forecastr and finding out if it's a right fit for you, we'd love to do that. Jimmy's going to throw a link in the chat right now that you can use to get started, and that's going to pair you up with an AE from our team to chat about Forecastr and how it can work for you. And without further ado, we're going to talk a little bit about our judges. So Stephen, I'm going to let you go first since you're on the left-hand side of the screen and talk about yourself, and then we'll go to me, and then we'll kick it to the companies.
Sounds good, brother. Hey guys, I am Stephen Plappert, co-founder and CEO of Forecastr. Been a serial entrepreneur been an entrepreneur for 10 years, started a couple different businesses, taken them both through Techstars. So Forecastr is proudly a Techstars company. I also took my very first company right out of school that I started back in 2013 called Fantasy up through Techstars as well. So I've spent 6 years as a founder, and in between those two companies, I spent 4 years as a fractional head of finance for lots of different startups. So built my fair share of financial models and raised some venture capital in my day as well from Louisville, Kentucky. And yeah, stoked to be here with you guys. Back to you, Logan.
Big time. Thank you very much, Stephen. I am Stephen's partner in crime here. I'm the co-founder, chief operating officer over here at Forecastr. I too have been a fractional CFO turned entrepreneur. You can see this on the screen, built over 200 financial models, which at this point, I don't know if that's something to brag about or cry about, but I put it on here. But I've also sat on the other side of that table. I worked as a fractional analyst for a couple of different VCs. And I actually even helped manage the Kentucky Pension Fund for a few years. So know the ins and outs of finance pretty well from a bunch of different angles. So we are going to get into the meat of the content now. So we have a lead, and I'm sorry if I mispronounced your name, from Wearable Sensing. So what we're going to do, kind of the format that we're going to use is we want to give you a little bit of time, maybe 5 to 7 minutes, just to give the audience a sense of what your business does, just kind of a high level pitch, just to give some context into the financial model. Then we're going to bring up the financial model, have you walk us through that for about another 5 or so minutes. And then we're going to turn it over to Stephen and I to give some feedback on that. So if that sounds good, the floor is yours.
Thank you, Logan. I'm going to share my screen. That's all right.
Sure thing. I'm going to stop sharing and then yep, you got it.
Thank you. All right, so I'm going to present this and really highlight the points that are relevant for building the financial model. This is not meant as an investor pitch, rather just to give the context of the story so that when you build a business model, it makes sense. So the business we're developing is called Brain Gym. It's a brainwave rehabilitation therapy for mental health. The background of the story is that we're working in mental health. So people, 1 in 5 people in the United States suffer from various types of mental health illness, costing several trillions of dollars in lost productivity. The solution today is to give people drugs, which are generally effective, cheap and easy, but they have a number of downsides, side effects. They really don't cure, and they lead to addictions that can lead to death. So drugs are a good solution, but not a great solution. Are there alternatives? Yes, neurofeedback is one such alternative. Neurofeedback is a non-pharmacological treatment that works by principles of neuroplasticity. So basically, you get a workout for your brain, and I'll describe that a little bit for you in a minute, and basically try to place a game that people can do. It's like working your brain in the gym. It rehabilitates your neural networks. Effects last a long time. There's no addiction, no death. The science is good. I'm not going to talk about it right now. I'm not going to talk about the background of what we've done, but we've essentially raised $32 million of non-dilutive funding to get to this point of where we've developed the technology, validated in the market, and now we see an opportunity for fast growth. So let me tell you a little bit about that. So what is neurofeedback and how does it work today? So today, the status quo is you go to a clinic, they put a cap that looks like this picture you see over here. They fill it up with gel. There's a technician sitting in the room tweaking the software. You have to come to the clinic 42 times. So one technician can really handle about 50 patients per year. So this is what their financial revenues look like. A patient costs about $5,000 to $10,000 out of pocket. There are some reimbursement codes. The clinic ends up making about $250,000 to $500,000 per technician. And we have been selling hardware to these clinics. So we've been selling them something costs about $20,000 per clinic. The new business model, once COVID came and we saw that people were adopting telemedicine and remote medicine, our technology allows us to have one device in the clinic that the patient first comes in, puts a device, they get screened, we determine what they need, and then we give them a device that they take home with them. It looks smaller, has VR in it, and now the cloud allows us to monitor them at home. So they do the remaining 38 sessions at home. So 4 sessions to train how to use this device in the clinic, 38 sessions at home. This allows us to have much greater number of patients per year per technician because they're not having to come in and spend the time with you. We can monitor them remotely, reduces the cost to the patient, increases revenue for the clinic, and best of all, it changes our revenue model. So how's that working? We are going to be leasing devices. We're going to lease each clinic a device. We call the clinic device for $2,000 a month. And we're going to lease for each patient that they get, we're going to lease them a device to use at home at $350 per month. So these are going to be our revenues generators. So if we estimate by the time we get to 600 clinics at $2,000 per month, 12 months a year, we're getting $14 million. And we're going to get some revenue from each of their patients. So we're going to estimate about half capacity, 200 patients per clinic, and we're going to be making $126 million. I'm going to skip over the market size and segmentation for right now, just to say this is a very large market. There's a $300 billion market. Is there competition? Yes, there is. I'm going to skip over that for today's purposes. Again, I'm going to skip over the team. And we're not going to talk about the raise, I'm told. So I think this is really it. Really what the remaining part that was needed for this model to make sense is we still have some technology development needed. So we're going to need some additional resources in our team, engineering wise, and then it's going to be scaling up, building a sales team and a support structure. And those things have to scale up as the business scales up. So I think I'll leave it here for now, unless you have any questions on the business model itself that you may need in order to understand better the financial model.
None from me. I will make a comment, which is congratulations for getting $32 million of non-dilutive funding. That's incredible. And I imagine that is no easy feat at all. So, hats off to you for that. So I think we're good on that front. I'm happy to take the screen back over, and then we will... I'm going to open up the financial model that you submitted here. Now, since I'm going to be driving, you just guide me to where you want to go, but we're going to take maybe 5 or so minutes just to go through this model in your own words and kind of the logic behind it. And then Stephen and I will talk about it.
Sure, thank you. So what we have on the left side are the resources that are needed, and we looked up on to determine the salaries for each of these people. We looked on salary.com, determined San Diego's rates, put those in. And then you have each quarter going in the next columns as to when we start hiring the person, we start putting in the amount of money that they'll be paid per quarter. So we start off with a CEO, director of operations, some administrative teams, and then we scroll down and we go into the marketing and sales team. And you notice there are a lot of technical support people that don't show up until much later. And for each of those, I had to put in a special line, and we can add them. If you scroll to the right a little bit, you can see that some of those guys really show up in the very last quarters. And this is manually us saying, okay, well, this is when we're going to need to bring in one extra person. So it's really manual here. And the same goes for the salespeople. And then we have, sorry, if you can scroll up just a little bit. Then we have some regulatory folks. And then we have under the regulatory folks is the VP of engineering. And here's where we have some of our engineers in team, and then our manufacturing team. And again, as we start scaling up manufacturing, we need more and more manufacturing technicians. And you scroll down some more, and you start getting into where are support people? Yeah, so there's travel expenses, there's some software developers, fixed costs here, travel expenses, and those increase as we get more salespeople coming on board. There's an equation there that calculates those. And then we have some conference and marketing costs, some hardware costs, and some regulatory costs, and then some fixed rent, office supplies, computers, and those scale up by the number of employees we get. Accounting costs, and that covers our expenses here. And does this sheet go down further to show the revenues? Yeah, so I think in this one, I tried to put everything in one sheet. So there we try to model in Excel the number of salespeople we'd be getting, the number of sales per person, the number, a little bit of attrition calculated, fractional attrition, the number of, so since we have each clinic has home users, we have to calculate how many home users they have at a certain point. And there the calculations got hairy because we have things that are per quarter, things that are monthly. So then we calculate the revenue streams coming in from each of the clinic headset subscriptions and the home subscriptions. And that gets us to our gross revenue calculations there, which are initially per quarter, and then we have to do annuals. And then the next section we can ignore, that's the sort of the existing business revenue, because we are already in business, we're already selling products. So that's sort of how we calculate the existing business's revenue. But for today's model, we can skip that. So that gets us to our total gross revenue and our total annual revenue.
Very
That's
cool.
a very quick rundown of what we have in our model here.
I love it. Okay, well, that's really great. And I'm just going to really quickly, just for the sake of time, just thumb through the rest of the tabs, just super quick. So we've got this with your revenue. We've got some cumulative stuff that we've got here, manufacturing costs with some good input cells here, other expenses. We've got some grant revenue with some nice little flow charts here as well as a bit more on revenue and some notes. You can see there's a bunch of tabs here, just kind of thumbing through. So I'm happy to kind of jump in here and start giving you a little bit of feedback from my end. And I know Steven's also reviewed this model, so I'll give him an opportunity to give his feedback as well. So the format that I like to use here is kind of what I liked. I like to start with what I liked, and then I like to move into the things that I think could really use some improvement. So one of the things that I really like is that there are definitely elements of this model that are bottoms up. So, you've got modeling a number of salespeople, right? And then that's kind of driving your revenue ultimately. And so there's some good kind of bottoms up logic here, which is really important whenever we're looking at financial models. There's a lot of good assumptions of, kind of scattered through the model that are very much unique to your business. It's very obvious that a lot of time and effort was put into putting this model together just based off of all the different assumptions that I can see here. I do also like that there are definitely instances where there are inputs clearly labeled. You can see right here, this is an input because it's orange. That's very easy. It makes it easier for it to navigate for me. And there are also some visually appealing elements here, in my opinion, like this Gantt chart is very easy to understand, easy to digest. So it's very, something that's easy for me and doesn't require my brain to do a lot of analysis, which is really good. So those are the highlights of the things that I really liked about this model. But I'll move into the things that I really think could use some improvement here. One is that there, from what I can tell, there's no real succinct financial statements here. So there's no income statement, balance sheet, statement of cash flows. Because of that, you could argue that this isn't a complete financial model because those statements aren't there. I think that that's super important when it comes to financial modeling, just to give you a sense of high level things like annual revenue, cash runway, burn, all of that stuff is going to be really, really important. From a visual reaction, it's a little bit disorganized and hard to follow. So like, for example, there are several different expense tabs. There's an expense revenue, there's an expenses revenue simplified. There's a couple different revenue tabs. It can be very confusing if I don't have context to be able to try to digest this model and try to understand exactly what's going on here. Likewise, it's not super visually appealing to me. Like the numbers, kind of the formats are all over the place. There's a bunch of decimal places that makes it a little bit difficult to follow. And there's also no visual analysis going on to help me digest the output of the model. I've also got a comment on the ref errors that we see, right here. You can see that there's some ref errors. It just erodes confidence anytime that you see those types of things in a financial model, as well as several hard-coded numbers that aren't formatted as such as well. So all of these are just hard-coded in. And you said that's very manual. Rule of thumb is if you hard-code something, you want to make it known that it's hard-coded as well. So those are my high-level thoughts overall. Stephen, anything you want to add to that?
Yeah, would love to, man. And thanks again, Waleed, for kind of putting yourself out here and letting us walk through this model in real time. I think, like Logan said, I mean, one of the things that I like the most about this model is the really granular kind of expense assumptions, as well as some of that bottoms up stuff, like Logan said, with the kind of walking through the salespeople and how revenue is built. I also thought you did a good job of just kind of articulating, the business, which is a big piece of using a financial model in a fundraising environment, is actually presenting the model and kind of walking through it in a way that kind of logically makes sense and steps someone into the model. So I thought that was good. And like the expense side is really nice and granular. There's a lot of good depth on the hiring plan, on the other expenses, predominantly on the income statement. I think that because of your business, especially like where Logan said with the financial models, I think you really do need a balance sheet represented in this model, given some of the manufacturing dynamics and the physical product that you sell. I would have to venture a guess that there's a lot of cash flow dynamics at play, that maybe don't hit the income statement. And so I think that's probably the biggest knock on this model, is just producing all three financial statements. So just kind of give everybody in the room a sense of what Logan and I view as like kind of the North Star in modeling as far as output. You want a monthly set of financials going out the next 5 years, typically, if you're looking for venture capital. It could go out longer, which Waleed's does, which is really nice. But you want monthly financials, you want all three financial statements: income statement, balance sheet, and the statement of cash flows. You want good representation of kind of the revenue model and how the revenue engine works. And then ultimately you do want it to be designed in such a way that it's rather easy to digest. And I think, just to kind of double tap on it, I think biggest opportunities for improvement in this model is cleaning it up, like removing information that's no longer needed, like some of those duplicate tabs. Just cleaning everything up from a design perspective to be more organized and digestible, and then making sure to orient the model around those three financial statements. And we prefer to see it monthly rather than quarterly, just because so much can happen in a quarter. Now, your business is also, I think, quite far along, as I understand it. And so for you, you could get away maybe with quarterly if you've got some good solid historical data and some good like kind of stability to the business. But we'd still probably like to see it underlyingly forecasted monthly and then rolled up, quarterly or annually. So that's kind of what I would add. Some addition and some more just kind of double tapping on what Logan said.
Yeah, very cool. So thanks, Stephen. And just to give you a really quick sense, we did have one of our analysts put a quick structure together. Now, there's no numbers in here as of right now of what this could look like. So you have different ways that you're acquiring customers, different kind of like aspects of things that you're doing, which then rolls into all of the different revenue streams that you have. And that can be, spelled out in any different ways, grouped in a bunch of different ways, along with people, expenses, but then they all roll up to the big three financial statements: the income statement, balance sheet, and statement of cash flows. So just wanted to, thank you again for, getting up here and letting us look at your model, presenting your business. I know that it can be difficult, doing this in front of a large group of people. I think you overall did a really, really great job. I think that, the logic of the model and the thought that got put into the model was really, really, really impressive. And I think if you tighten it up, that can be an A+ model. So, thank you again for getting up here and letting us tear it down.
Thank you, guys. I can add if for a second that, I did work, followed up with, since we posted this up, and I did work with one of your team and build a more detailed model. And I will say a few things. Would you like me to share a little bit of feedback on that? I'll give mostly the good, and it's mostly really good. So first of all, the analyst I was given is fantastic, really bright guy, followed the storyline very well. I realized I had a complicated model. He cleaned it up. It took me a while to relearn all the features and how to use them, but he was genius and build up. One of the really nice things that we were able to build up is the automation of things. So instead of me adding salesperson at a time, we could let the pipeline coming in increase automatically, dynamically change the number of salespeople, the number of technicians that we needed. So our expenses could scale directly with the revenue. And that allowed me to then go in and tweak the numbers on the incoming side and see how those things influenced my revenue stream. So those were really nice pieces that I could see. The ability to change things from monthly view to quarterly view becomes really nice. And I haven't yet delved into the financial outputs, but the only downsides I would say is it does take quite a bit to learn, but you guys solved that by providing the white glove onboarding, which again, really made a huge difference in getting a functional model and very, very short order. So thank you.
Thank you so much for the kind words. I'm really glad you're having a good experience there. And yeah, we did talk to our analysts and they, you said really great things about you. So appreciate you again jumping up here and talking with us about your business. All right, so we are right on time here. We are at 3:30, so we're going to be moving on to our next founder, who is going to be John. Now, John is very brave for getting up here because he is not a native English speaker, but we are very, very excited to have him here to tell us a little bit about his business, and then we're going to jump into his financial model much in the same way. So, John, if you're ready, would love to invite you to maybe talk about your business for just a few minutes.
Hello, I'm John. My project is grid independent electrolyzer. Grid independent electrolyzer can disconnect the grid power to hydrogen production from the water. Existing technology of hydrogen production requires stable power. So even using the grid or wind or solar power for hydrogen production, it requires connecting the grid power for keeping a stable power. But our solution can disconnect the grid power. The difference is in our solution, each electrode can be controlled by cutting in and cutting off based on the voltage change from the wind or solar. Each electrode can be controlled in parallel connecting based on the current change from the wind or solar. So this is our difference. We didn't change the price of hydrogen production. We only control the electrode and the electrolyzer based on the power change from the wind or solar. So this is our innovation. Thank you.
Thank you so much. We appreciate the context, John. So what I'm going to do now is I'm going to open up the financial model that was submitted here as well. And I'll just kind of talk through this a little bit. So, just to kind of go over what we see here on the screen. So it looks like we have two different products. We have a small product and a larger product. We have a customer's quantity up here, so we can see how that's going to be growing over time. And then we can get a sense of the sales revenue and the profit that we're going to be seeing. So it's kind of a high level output of an income statement that we see here with some cash as well. And then I really like, you've got a timeline and a uses of funds as well. So you can get a sense of how you're going to be spending the money that you're going to be raising, how you're going to be growing that business as well. So this is the model that John submitted. Stephen, I'll maybe kick it to you to see if you have kind of any thoughts, feedback, anything here for John.
Yeah. We have two types of products. The customer and the sales model are different. One product is small, hydrogen production and the refueling station. Its customer are the user or manufacturer of hydrogen vehicle. The more hydrogen vehicle, the more hydrogen production station, the more hydrogen vehicle sales, like a charge port of an EV car. So this customer is sensitive on the accessibility. Another product is a large-scale hydrogen production station. This customer are owners of a wind farm or a solar power station. This customer are sensitive on the hydrogen production cost. only the sensitive the cost of hydrogen. So because our products are facility of energy, so each production cost is higher. The smallest hydrogen production and refueling station sales price is $100,000 for 1 unit. The large scale hydrogen production station, maybe the selling price is millions. So currently we have one customer in for the large scale hydrogen production station. So this project, the revenue will be 10 million. So if we successful produce the first production as showcase, we can get the first order from this customer, because only we get the real products and the certification, and then we can sell products. So this is our problem. Our business model is at the first stage is assembly the hydrogen production station and produce the controller of electroder and electrolyzer by ourselves. OEM the special electrolyzer, assemble the system. So this is our sales model, business model.
Awesome.
Thank you
so much, John. We appreciate it. Stephen, what are your thoughts?
Yeah. Let me walk through. Thank you, John. Thank you for kind of giving us a little bit of context about your company. So what we see here on the screen, Logan and I would actually call this financial projections rather than a financial model. And those are actually things that kind of get confounded or confused quite a bit. We see so. I want to describe the difference a little bit of those, for John and obviously for the benefit of everybody here on this event. So the financial model, that would be kind of a set of calculations that is producing some output. So a model is going to be a bunch of formulas and calculations and things that are designed to describe the underlying mechanics of a business. And it's like a simulator that you put inputs into. And it spits out basically what's on the screen here. It spits out a set of financial projections, which would be the output of the model and what would ultimately get consumed by you as a business owner to make decisions, or by investors, of course, to make decisions on investment as well. And so, so I guess the first comment would be to say that what we're looking at here actually isn't a financial model, but rather the output of the financial model. And so you do have some good kind of high level output represented here, such as the customers, the revenue, gross profit. But it does leave a lot to be kind of questioned and desired. So kind of peeling back that onion, much like we said when we looked at wearable sensings, like we want monthly financials, we want all 3 financial statements, and we want to kind of get into the underlying mechanics of the business. So it's very difficult for me to understand kind of where the customer quantity is coming from, the revenue line is coming from, because you can't get into any of the mechanics. Like I imagine for your business might be enterprise sales, large contracts, small customer volumes, things like that. But you can't see any of that. We can't really get into any of the expenses and the assumptions that you're making with respect to how expenses scale with the business. So, it's very limiting kind of in that sense. And then the other thing I would say is, just kind of judging the output here, it's very aggressive. We go from 10 million in revenue. Looking in just the small product, if you look at the large product as well, it's another 10 million in revenue, total revenue of 20 million in 2024. And then that scales up to $26 billion in annual revenue in 2028. That's a really aggressive ramp. And man, if you hit that ramp, I want to be hanging out with you. But I would say that might be viewed as unrealistic to investors. And for yourself, when you're planning your cash flow, how much money you're going to raise, et cetera, if you have really aggressive revenue projections like that, it can lead you to think that you don't need to raise as much money as you do, or that your runway is longer than it actually is. So I would say, kind of in summary, be very careful with revenue projections, and I think these need to be tamped down to a significant degree. And then we really want to kind of be able to peel back the onion here, get into the actual model, the calculations that are generating, these outputs. And we'd want to be able to see those revenue mechanics represented, customer acquisition, monetization, et cetera, as well as the expenses, and the balance sheet items, forecasted out through time and then summarized to give us this output here.
Yeah. Good thoughts all around, Stephen. And I think that I align. I really don't have a whole lot to add there. I think that, you really covered everything here. One other thing that I'll add is, like, I would, if we are going to do kind of like a one-pager type of deal to share around with investors or folks, I would maybe dress it up a little bit and make it look a little bit more visually appealing. I will actually just click this really quick to give you all a sense of some of the stuff that we like to do with our clients. So just make things a little bit more visually appealing so that you can kind of get a quicker sense with some visuals as well. But I echo Stephen's sentiments when I say not quite a financial model, but some helpful, useful information on here. So thank you, John. Thank you to both founders for spending some time walking through your all's financial models. We really appreciate it. And just for the sake of time, I'm actually going to jump into Forecastr's financial model just to show you guys.
Before you jump in there, I want to interrupt Logan, because there was a question in the chat that was very relevant to where you guys were just at from Crispin Courtenay, which thank you for the very active chat who's been kind of singing our praises as well as answering in the vein that we usually do. But Crispin asks, why 5 years? That's like grazing into a crystal ball with pixie dust. Even 3 years is pushing it. A most common and very good question and very accurate question.
Yes.
But throwing it to you guys, in this weird world of startups, why these 5-year projections? And I will say, John's financial model is exactly what's on your Gust. Not financial model. The projections is exactly what's on your Gust profile. If you notice when you set up your Gust profile and you go to the financial tab, it doesn't say model. It says financials in a little table, usually 5 years in advance. And that's a very specific number for investors. And it is about, well, I'll let Logan do it. I'm not going to steal his thunder. Why 5 years, Logan?
Why 5 years? Well, okay. So 5 years is because it's kind of the universally agreed upon in the venture-backed ecosystem amount of time that it takes for you to go from starting a business to reaching some sort of stabilized economics for your business. So for most startups, whenever you start out, you're not profitable, you're usually raising money, you're burning that money, and you're using those funds in order to reach some point of stability in your business. So if I'm an investor and I need to understand that, you're probably going to be burning money for the first year, 2 year, 3 year, 4 year, whatever, like X amount of years, I still need to have some sort of line of sight into the profitability of the company and the long-term economics of the company. Usually 5 years is about the right amount of time in order for you to hit some sort of stability in your business. So if, whenever I'm looking at our financial model, for example, if I want to understand how my team's going to scale, how many clients a certain analyst can hold, what the revenue is going to look like, and how all of this kind of scales out over time, 5 years is about that time for us to hit that point of stability. So, Stephen, I don't know if you want to add anything there, Ryan, you as well. But
I'll just add a couple other notes, which is that, like I always tell people, it's like the reason why it's so critical to do monthly out 5 years is because, like, you have these two focuses when you build a model. There's the operational focus around making better decisions, around like understanding the financial health of your company. And for that, you need monthly visibility, and like 18 to 24 months is typically the time horizon that I would advise you to just like to think in. I mean, even focus greater on even shorter time horizon, but 18 to 24 months is about that funding timeline when you might raise additional capital or just have some level of visibility into the future. Beyond 24 months, it really is all storytelling in a lot of ways when you're fundraising. It's telling a story that, hey, like, you can, first of all, conceive of a large company, you have a big vision, and you have reasonable assumptions and reason to believe that this could look like a really solid company that's profitable, that's high growth, and so that those years 3 through 5, if you're fundraising, I would view them as as telling a story, basically telling a story and communicating kind of your intentions behind the company, that it is to grow it at a high clip and to grow it quite large.
And I will use that as the perfect segue from Forecastr to Gust. The last really, I will use Forecastr's terminology of double tapping. The reason why we have it in the Gust profile is professional investors in the early stage and in VC, angels, VCs, micro VCs, they have a portfolio strategy. They're not just falling in love with one company that they want to just put money into because they love the purpose. They're trying to invest in 30, 60, 70, 80 companies to diversify, because the reality is most companies fail. So most angel investors, and especially VCs, need to see that the potential for this company and the thought, like Steven said, that goes into it, goes up and to the right to make up for all their losses. So they're looking at 30x returns on investment. If your 5-year forecast has you growing at 5% year over year and like flatlining, that's showing that you as a founder are not thinking of the kinds of returns necessary to actually get angel investment. And it's a really revealing part of like where the founder actually thinks the business can go. You can go too crazy, where you go up and to the right so fast that they're like, there's not enough people on earth to buy your product in order to actually make you successful the way you claim to be. But often you can go in the other direction too, which is just too conservative and not building on those network effects or positive feedback loops, or just the thing that needs scale. I'm not saying that every company needs to have a Facebook up and to the right channel, but even for like, angel investment groups who aren't looking for necessarily the next unicorn, but are still looking for hundreds of millions of dollars of kind of potential acquisitions or go public stuff, so that their investment will actually return something to them.
Yeah, it's great thoughts. And actually, I will segue this into showing Forecastr's financial model, because it's a good representation of what we're talking about here, of basically storytelling, but then also showing kind of what stabilized economics look like and things like that. So just really quick, this is Forecastr's financial model that we use. I'm actually going to send this out to the 5 years, 72, or that's actually set 6 years to 72 months. But you can get a sense of how we like to forecast things over here at Forecastr, where we do a bottoms-up approach. We're theorizing in this customer acquisition section, which is trying to show how we're going to be growing and the strategies that we're using. We have specific counts for number of customers that we hope to acquire on a month-to-month basis. You can see that we even have split goals within the month to just try to understand how we're going to be growing, the levers that we're going to be using in order to grow the business, and how that's going to look. You can see that kind of up and to the right that you're seeing here that Ryan was talking about. And that feeds directly into revenue streams, where we can talk about how revenue is going to be growing and all of the different products that we offer and all of the important metrics that make up the logic of that revenue growth. Things like churn rate, downgrade rate, upgrade rate, things like that. Very important for a model. But you can really dig in here and get a sense of the logic that we're using in the detail that we leverage here as well, all the way down to the specific people that we're going to be hiring, what we're going to be paying them, all of our other expenses as well. And all of that culminates into the financial statement. So we've got the income statement, the statement of cash flows, and the balance sheet. Now, in an online integrated web app, one of the benefits that you get is the ability to integrate directly with your accounting. So what we can do is just hit this actuals button, and we can even hit this variance button and understand how we're performing in real time versus our goals. So that's kind of how we structure it. And I could spend a whole webinar going through our financial model, but for the sake of time, I'd like to spend the majority of the rest of the time going through the insane amount of Q&A that I'm sure that we've got. I've been seeing the chat pop off. But before that, I do want to say that we want to offer everybody on here a special offer of 20% off of Forecastr. We're also going to waive the implementation fee, which is traditionally $500, and give you access to our Investor Connect platform, where we are going to help use your data to pair you up with investors that are interested in the space. Just to give you a quick sense of how Forecastr works, we really have 3 separate packages. We're focusing on 2 right now for the 20% discount, which is our Essentials package and our Growth package. So one of the things that makes Forecastr different is we don't just hand you a financial model and say, there you go, have fun, go pitch investors. We stick around for the entire lifetime of your subscription. So if we're looking at the Essentials package, it's only $500 a month or $400 per month with the discount. We're going to give you a dedicated analyst. They're going to build you a model. They're going to update it every single quarter. They're going to give you reporting on that model that you can then send to your investors. And it's going to really help be that starter kind of financial planning function for your business. Once you've raised, and that's perfect for companies that are fundraising. Once you've maybe secured some money, you're more operational. The growth package is incredibly valuable, where that analyst is going to update your model on a monthly basis now, give you even more robust reporting, as well as quarterly investor reporting on top of that. It's really going to take your financial side of your business to the next level, all the way up to CFO packages that start only at $1,500 a month, where we can really dig in and do some special projects for you, in addition to everything that we do on the essentials and growth packages. So if you have any questions on how Forecastr works, or you just want to find out more, I encourage you to get in touch with us using the link that Jimmy's going to throw in the chat right now. He's probably thrown it in there about 10 times by now, but he'll throw it in for an 11th. And with that, I will open it up to questions and discussion. And Jimmy and Ryan, I assume that you guys have kind of kept your eye on the chat. So anything you want to call out for us to talk about?
Yeah, we've been doing a lot of them live, and the chat has been blown up. So if I miss one and you really want an answer, use the Q&A functionality, because that actually gives us like a ticketed system. But the first one we have here, I just lost it. Well, we'll jump into the proper Q&A. So anonymous question is, so there is an analyst that receives our financial information and then updates it on Forecastr. Is that part of the offering?
That's correct. So it depends on the package that you're on, but either way, it's going to be correct. So the analyst will have access to your accounting data. They're going to go in, update your financial model. If you're on the $500/$400 with the discount package, they're going to do that on a quarterly basis and keep it up to date. And if you're on the monthly package, which would be $800 with the discount per month, then they're going to do that on a monthly basis. Either way, in the initial build, they're going to be working hand in hand with you to get that initial model built.
Awesome. Crispin asked another good question a while back. So they have actually pitched to VCs, and VCs are asking for like the full financial models. Like, who is looking at this? It's some analyst. They're going to read this. So the person writing the check actually going to go and like spend hours digging into my financial model.
Steven, you want that one?
Yeah, I'll take that one. And this one's definitely near and dear to me. So talking to a guy who just last week, we closed $4.5 million, oversubscribed on a $4 million round. And it was a 7-month, journey for us. We spent the last 7 months basically raising this round for Forecastr. So I pitched a little bit over 200 investors in that process, and generally did find it to be a pretty difficult market to raise capital in right now. So I think we're counting our lucky stars that we got that round done. But you're talking to a guy who just came off, the front line, so to speak, of fundraising, and has spent a lot of time pitching investors. And I'll say, so a couple of things. One is every investor is a little bit different. And one of the things that I take into fundraising is kind of a chameleon approach, if you will, where I'm trying to speak to everyone's interests. Some investors are really financially minded, and they want the numbers. They want to understand, have you critically thought through the business and how is this business going to scale? I would say that the majority of investors are in that camp. And so for those investors, you really want to have a financial model. You want to be able to defend it. You want to be able to just articulate your business. And the way that you do that, though, isn't share the model with the investor and them spend hours going through it, because you're right. They absolutely will not do that. No investor will really do that much, not early in the process, at least, maybe deep down in diligence. But the way that we've best seen financial models leveraged in fundraising, the way I've leveraged them in my career, is presenting the model to investors. That's the really powerful piece of it, because it's a lot more about your critical thinking and your thought process and in your approach and your ability to articulate that than it is about the numbers as such. And so we see it as a very good conversion mechanism from an early conversation with an investor into diligence. And you should use it just like you use your pitch deck, as a supporting element to an oral conversation, right? I use the model to just support what I'm going to tell the investor as my numerical narrative. How do we acquire? How do we monetize? How do we scale the team? How do we become $1 billion company? And so what I found is, if you can deliver that narrative on top of the numbers, it's this special blend for a lot of investors where it drives a ton of conversion. Then there are other investors out there, especially if you're really early on, pre-seed seed capital, they won't take as much stock in the model. And for those investors, you may bypass that piece of the process, and that's totally fine. If an investor is going to be investing more on people, on team, that kind of stuff early on, it's totally okay to just kind of play to the room, right? But our philosophy is always like, be able to play, to the room. Most investors do want to see a model. Analysts will spend some more time digging into it, but focus a lot more on the storytelling, on the narrative, and on the numbers, just helping basically give credibility to that narrative, rather than expecting an investor kind of spend a bunch of time on their own on it. That's what I would say. Great question too, by the way.
Yeah. And I'm also going to riff on that from one I put in the chat. We've done an event with this team specifically about how to use the financial model in the fundraising process and using it as an asset and a support thing. And I think, Logan, you're on that one. They go deep into all of the various kinds of investor conversations, from the elevator pitch all the way to like the VC analyst thing, and what level of aperture or resolution is appropriate to be sharing your financial model and what kind of conversations you want to have. So way too much content to jump into this one, but if you want to watch that on your own, and there'll be another one in the future, people love that event, so we keep doing it. I will say from the Gust side and the Gust and Forecastrs, like spiritual alignment is kind of what Stephen was saying, is like the next level. You might be raising a seed round right now, but if you're going to go seed, then you'll probably go Series A. The next level, almost all of this stuff that we talk about is table stakes. So like from Gust Launch standpoint, in order to get actual investment, like a Delaware C Corp is table stakes. Good vesting, stock grants to your founders are table stakes. Having, your COI tight, enough shares, everything that investors expect. No Series A company is going to get that investment with like a cobbled together LLC. Same thing with financial models. No Series A is going to close without a detailed financial model. Investors expect that. They need it. It is very important to their portfolio strategy. However, what is table stakes, that's the next stage, is a massive competitive differentiator at the early stage. So if an angel investor is going to see literally hundreds of deals a month, and most of them have, a handful, like a up and to the right, super smooth financial models and whatnot. Like I said, they might be really looking early. They might be looking at team composition, market, and things like that. But if not only does your idea, your elevator pitch excite them and fit into their portfolio, but you've done the work to actually build a model, that shows so much differentiation amongst all the other startups there that probably just have, a 2-tab Excel sheet and that hasn't really put that thought into it. So I think both of our companies are kind of like, and let me tell you, it's a tough market to sell vitamins instead of painkillers, but most of our companies really go after that. Be more proactive, get, your stuff set up early, and you will competitively differentiate yourself amongst the thousands of other people out there.
Yeah, very well said.
All right, do we have anybody else? Oh, James Dean, who also, thank you for being very active in the chat and helping other people out. James asks if you do public companies.
Oh, that's funny. We don't anymore because we decided that it was just too much of a liability. So whenever you're working with public companies, you have access to non-material, non-public information, which puts our team at risk. So our kind of stance going forward is we're trying to stay away from public companies for only that reason, not for lack of the platform. It's simply because it puts kind of us in a little bit of risk.
Right. That's an insider trading risk, I imagine.
It is.
Yeah. If any forecaster employee is like, I just did the financial model for a company that's planning on acquiring another company, it's like,
It's tough. And the actual even trickier part of that is, even if you have an index fund that has a holding of that, that's technically, you can get in trouble for that. So it's really hard. And if anybody in the company has stock in it, it becomes an issue. So
yeah, and that is, everything is securities fraud in the public company land.
Yeah.
All right. Well, we're at time. I think we got all the questions. Again, Waleed and John, thank you so much for coming up here and kind of giving us the fuel to go through this. I will say, Waleed, from the pitch deck standpoint, you gave me a succinct, 360 view of what your company is, where it's at, how it differentiates, what the market's like, what the problem is. I love that. That was fantastic.
Thank you.
Appreciate
Thank
that.
you.
John, thank you for sharing. Look out for more of these. Everybody asking, this will be recorded and we'll share some stuff out in a couple of days. We'll also share the link that Jimmy's been throwing in the chat, but please check out Forecastr if their needs are going to meet where your company's at. Stick around for more emails from me because we'll do more programming with the team, and have a great week, everyone.
Thanks everybody so much. Appreciate it.
Bye.